All right, welcome to The Explainer. Today, we're going to dig into something that really affects pretty much everyone's financial future. A powerful and maybe even misleading idea about how we're supposed to build our retirement income.
So let's just start with a big question, one that gets right to the heart of how we think about investing for the long haul. Are the assumptions you're making, the ones your entire financial plan is based on, are they built for reality or are they built on a fantasy?
You know the dream, right? We've all heard about it. It's this beautiful idea of compound interest, where your money just works for you, growing bigger and bigger all on its own, without any bumps in the road.
And just to show you how powerful this dream is, the source material we're looking at uses a super simple example. Imagine investing just one single dollar a year. With a steady 8% return over 30 years, your $30 turns into about $124. And if you stretch that out to 40 years at 7%, your $40 contribution becomes more than $200.
I mean, think about that. In that first scenario, that's more than 4 times your money. This is the kind of powerful math that gets everyone so excited about the idea of long-term investing.
But, and this is a huge but, it brings us to the most crucial question of all. How likely is it, really, that anyone can get that kind of perfect, smooth return, year after year, for decades on end?
Well, the source material that we're digging into has a very, very clear answer to that. And for some of you, it might actually be pretty surprising. It's time for a little reality check.
And there it is. This quote right here is really the core idea. The author says that expecting those smooth, high returns isn't just unlikely, it's sheer fantasy. And the reason why is something every investor, sooner or later, finds out the hard way.
The culprit, the thing that shatters the dream, is market downturns. The reality is, markets are choppy. They are anything but a straight line up, and history is just littered with examples of huge pullbacks that can really hurt a portfolio. And this just lays it out so clearly. You can see the pattern. Big market shocks tend to happen about once a decade. You've got Black Monday, the dot-com bust, the global financial crisis. It's a theme that just keeps repeating. And the source is pretty clear that we should expect it to keep happening.
But here's the thing people often miss. The real damage isn't just the money you lose when the market drops. Nope. There's a hidden cost, and it's honestly much more damaging to your long-term plan. It's the lost time. The precious years you spend just trying to get back to where you were.
And the math for a recovery is just brutal. Let's say your portfolio takes a 20% hit. Well, to get back to even, you don't need a 20% gain. You actually need a 25% gain. And if you're only making about 7% a year, just climbing out of that hole can take you more than 4 years. That's 4 years of your life where you're not making progress, you're just recovering.
So think about what this does to your plan. The source figures that these downturns, which are basically inevitable, can wipe out about a third of your effective investing time. So your 30-year plan, it really becomes more like a 20-year plan. That 40-year horizon, it shrinks down to 30.
So, okay, if the dream of smooth, uninterrupted growth is a fantasy, then what should we be aiming for? With this new, more realistic view, we really have to adjust our expectation. Let's get really practical here. Let's apply this more sober outlook to a super common savings plan, putting aside $100 every single month. What does that look like in the real world?
Well, according to this analysis, once you factor in those lost years from all the market volatility, the numbers look very different. The amount your money multiplies by is closer to 2 times over 30 years, and maybe 3 to 3.5 times over 40 years. Now, the results are still good, but they're a long, long way from that perfect, uninterrupted fantasy.
So let's just focus on that 30-year number. If you invest $100 a month, that's $36,000 of your own money that you've put in. Realistically, you might end up with about $75,000. That final number reflects a journey that had ups, downs, stalls, and recoveries. That's the real-world outcome.
And we've got to remember, even these updated numbers are still kind of optimistic. They don't even begin to account for all the other real-world things that eat away at your returns. Investment fees, the taxes you'll have to pay, and of course, the big one, inflation, which is silently making your money worth less over time.
Now look, the point of all this is absolutely not to discourage you from investing. Actually, it's the complete opposite. The goal here is to arm you with a realistic mindset so you can build a plan that can actually survive in the real world.
And that brings us to the real takeaway. The source reminds us that even with all the chaos and volatility, your 2 most powerful weapons are still time, how long you stay in the market, and consistency, how much you regularly put in. So what's the bottom line here?
Building real financial strength isn't about chasing a fantasy. It's about understanding how the market actually works. You have to plan for the bumps. You have to have the discipline to not panic. And probably most important of all, you have to base your goals on reality, not a fairy tale.
And that really brings us to our final thought, a question for you to think about. Knowing for a fact that the road is going to be choppy, what steps can you take right now to make sure your own financial plan isn't built on a myth, but is truly ready for the journey ahead?